go. Well, thank you, Tracy, for joining here. Tracy is a partner leading venture capital and crypto for Albourne Partners. And to start, could you tell us a little bit about Albourne Partners and what you do there?
Sure thing. Well, thanks so much for having me, Aviad, and the MobileCoin team. Absolutely. So Albourne is an alternative investment advisor. We advise $600 billion of assets across 300 institutional clients, so a smattering of family offices, endowments, foundations, insurance companies, pension funds, through to sovereign wealth funds. So what I often like to think is that, on $600 billion, if we can tactically tilt even, 10 basis points of that allocation, perhaps we can get more capital into crypto in the right hands of innovation.
Definitely. And how did you come to this role? Like, what's your background?
Sure, absolutely. So I think I've come about this and in sort of the crypto sphere in two different ways. So one is I started at the intersection of finance and technology in the late 90s. So one of my first internships was as a sophomore in college in 1999 at a Sequoia and benchmark-backed company, webvan.com. So really informed how long-term technology adoption cycles play out over time. So not until $1 billion was spent on a $70 million warehouse facilities and robotics automations in quote at the time was spent at Webvan, did you then later see real technology adoption, consumer adoption play out in terms of grocery delivery in the 2020s and beyond. So some of that technology adoption cycle from the late 90s and across later technology, investment banking, corporate venture capital globally, and endowment management kind of led to institutional investing, and that led to where I am in crypto today. I think my journey in crypto really dates back to 2015 when through some of our hedge fund exposures at Albourne. So Albourne is one of the market leaders, if not the market leader in hedge fund advisory. We started to see Bitcoin being traded across hedge fund portfolios in 2015, and we've really seen the rise of that since. Today, in fact, if it's helpful to share, what we're seeing across hedge fund portfolios is about 80% of macro hedge funds now trade cryptocurrencies in some capacity, and close to 50% of long-short equity funds, so traditionally trading equities, are trading cryptocurrencies.
Wow. Well, thank you for that. I'm so glad you're here because there's like this elephant in the room in crypto that's been here forever of when are the institutional investors going to come in? If everything's going to be different when they come in, it gives this legitimacy, which is honestly a little weird because this is the future and that is kind of the past, but it does need to work together. And so it's almost like in Game of Thrones, winter is coming. It's going to happen. Has it happened? Are we there? Are those numbers, would you say those numbers mean they're here, or like what still needs to happen?
Sure. Yeah, that probably exaggerates, the sophistication for which some of these hedge funds are applying trading and other technology strategies around cryptocurrencies. So it's not quite here yet. Maybe some of the ways to frame the ways to get there include the traditional endowment model, which includes asset allocation, portfolio construction, and investment selection. And so some of these asset allocation frameworks really need to start to steer some of the assets of these institutions toward a 1% or 2% dedicated allocation to digital assets, and maybe even observe digital assets as a standalone asset class in its own right. Correspondingly, I think some institutions are seeing this interesting opportunity as they've become more and more exposed to the market opportunity to say, well, I'm going to just expose myself, from a hedge fund perspective or a venture capital perspective on a standalone basis. And I know you and I had a little bit of a conversation about this. We can talk a little bit about what those exposures might look like or what that journey might look like.
Yeah, our talk is called the Cambrian Explosion, and the reality is crypto today is so many different things. A few years ago, it was much more straightforward. You're betting on a couple different chains, and maybe there's an interesting application on top of it. But today, everything from DeFi to decentralized exchanges to NFTs, et cetera, how are institutional folks thinking about this space? Are they going across these different strategies and the funds that they look at? Is it more of just is this venture and investing in a company versus a hedge fund? Like where's the thought process?
Sure, absolutely. I'd say that the exposure extends anywhere from kind of passive long only, so exposure to Bitcoin and in some cases Ethereum, to maybe more market neutral strategies, which has a tendency to have more of a hedge fund trading strategy element to it, or in theory you can be short biased too, but I'd say that it's I'd stand to wager against short bias funds.
You can get burned in crypto if you're short.
Exactly. But those are the ways I would think about the extension of the exposures to the asset class. And then thinking about fund structures, for example, hedge funds just traditionally have traded large liquid pools of assets, often more esoteric in nature. And so a couple of the kind of categories of investment that we've thought through include three primary ones across hedge funds. So one would be liquidity provisioning, for example. So these are traditional kind of analogs in some cases to hedge fund strategies. So market making strategies, arbitrage strategies, for which there are so many in terms of exchange arbitrage or basis trading across different types of securities, through to yield farming, which many of us know from our decentralized finance exposures. There are other types of trading strategies that can be more discretionary in nature, so often a little more long-only fundamental, but not necessarily specific to that. Others that are algorithmic in nature, and that often is an extension of what some of these macro hedge funds are doing. And then lastly, fundamental, which bleeds into early stage venture capital. So hedge funds are doing this now with not necessarily that kind of early innovation cap on, but some of these hedge funds are doing some bottom-up analysis, some thematic analysis, and some event-driven strategies. And what's interesting about some of these hedge funds is that they can be strategic in nature, so they can play a role in providing liquidity to some of these assets, for which they can then propel the use cases and other aspects of these assets. Exactly, that's right.
You had mentioned something really interesting when we talked yesterday about some of the best-in-class managers not even taking outside capital.
That's right.
How would you describe the repercussions of that to the institutional investing ecosystem?
That's right. So I think that's one of the things maybe partly holding back some of the institutional capital going into the space, because in a lot of cases managers have made so much capital and personal wealth, and you wonder whether they're as incentivized, or on an individual by individual basis there's much more kind of key person risk associated. So I was just talking to a couple of people in the audience today alone where as a result, maybe more of the alpha lies in some of these esoteric assets for which they're not as safeguarded in a traditional institutional sense. Maybe the custody relationships or the multi-sig considerations differ a little bit than that of a large-scale Andreessen Horowitz, for example, where you're betting on one individual and their ability to manage private keys and the self-custody of a lot of these assets.
Yeah, the custody question, it's so interesting. This is a brand new dynamic, right? That you can control your own keys, and with great responsibility comes great risk. What are the blockers for institutional investors to feel comfortable with either these managers or just the crypto space? And what can the industry learn from this to try and help remove those blockers?
Sure. As a starting point, some of the manager dynamics that you and I just discussed a minute ago plays a role, and as it relates to the broader set of the team, some of the internal operations play a significant role, so the ability to manage the security and safety and custody of these assets, particularly if some of the highest alpha-driven digital assets require self-custody because institutional custodians aren't willing to touch those assets just yet. I think some of those limitations, external service providers, so much like in the late 90s, as everything else was sort of catching up, all these other service providers and or the institutional infrastructure layer of technology was trying to catch up. The financial infrastructure, I think, continues to need to catch up for institutional investors to feel comfortable. So, staking providers, prime brokerages, custodians, et cetera, in terms of external service providers. And I'd say another way to think about some of the limitations for institutional investors is probably across three primary dimensions. So adoption, regulations, and ESG. So, and an education really needs to take place across all three dimensions. So number one, what is the market adoption for each of the different sub-strategies? NFT and metaverse, DeFi, traditional kind of liquid large cap tokens to early stage tokens. So what is the fundamental adoption for each of these different categories or areas? The regulatory environment, as we've all seen, the House Financial Committee just met, and much of the discussion was around a couple of key topics: custody, stable coins, et cetera. So those regulations really need to play out, and we've heard a lot about that from throughout many discussions today. And the last piece is ESG. I think that there's obviously been some misinformation and some kind of FUD, I suppose, around the asset class, Bitcoin in particular. And that's one of the reasons I'm really delighted by MobileCoin, the fact that it's carbon negative in capacity. I think those types of projects, those types of initiatives will hopefully steer the industry in the right direction across at least that nexus of consideration for institutionals.
Thank you. Yeah, the ESG thing is so interesting. When BlackRock comes out and makes a pledge on changing their investment strategy around climate, it's huge, and whether they follow through it or not is maybe a different story. But do you see there ever being a privacy movement in the way that ESG came along? Could that become part of the way that investment managers think? And I guess as part of that question, what is driving institutional investors into the space? Is there anything philosophical about it, or is it just an economic opportunity?
Sure. Maybe I'll start with that and then come back around to other considerations for ESG. I'd say some of the drivers of institutional investors include kind of a commercial lens, so return on invested capital, a technology lens, so there's a kind of intellectual curiosity around that, and some hope that there's fundamental value driving return on investment. And then you start to get philosophical, and that's the hope that I have for institutional investors, but that's sort of my bias. And people like Faisal, for example, from Ideas Beyond Borders, really moves me in that direction about philosophical sort of censorship resistance and decentralization. So one of these crypto VC funds, Coin Fund, just published something today about the concept ladder for crypto. So I'm modifying this a little bit, but in the way that institutional investors will think about sort of an 8-step program toward the conceptualization around crypto. So you start, the primary on-ramp historically has been Bitcoin for institutional investors, right? So point 0 is crypto is money, right? So Bitcoin as a digital self-sovereign gold or a store of value. Point number 1 from there is then maybe crypto is payments, a la MobileCoin, in one of your various capacities. 2 is crypto is an inflation hedge. So we followed that story and the whole story of monetary policy. And then I think and then it starts to get a little hairier, and it starts to become harder work in terms of getting up the learning curve. So point 3 would be crypto as an efficient technology or innovation, so disrupting Web 2.0, for example, and truly creating a decentralized web. Point 4 being tradable financial assets. And at this point, institutional investors are starting to get their grip around the asset class for potentially speculation and therefore return on invested capital. And then an analog to that would be point 5, crypto as finance in the form of decentralized finance in a lot of cases. Point 6 being disintermediation. This is where the philosophical starts to click a little bit. These new incentive mechanisms for which self-ownership and autonomy really drive the new economy. And then crypto, number 7, crypto as networks, DAOs, networks of assets, et cetera. And point 8, cultural coordination, et cetera. And I think those last pieces, if you could really pull forward some of those philosophical pieces, I find that religion and philosophy can really drive institutions. And again, just going back to the original point, that 10 basis point shift on hopefully our $600 billion of assets under advisory could really move the needle. And as you go up that concept curve and set of concepts, hopefully there's better information, better understanding to look through to the environmental considerations, the privacy considerations, et cetera, that you sort of asked at the outset.
Got it. Yeah, I love that. And that's a tremendous amount of education we as an industry need to do for everyone to understand that, and a lot of work we need to do to really realize those potentials. Tracy, thank you so much for this conversation. This has been incredibly enlightening.
Thank you.
Thank you.